Healthy fundamentals have driven investors into the European rented residential market. Allocations to residential in pan-European core funds have increased from 0 in 2007 to 5% today. Still small, but that figure is growing rapidly. But European residential is not a one-size-fits-all proposition. There's a lot of variation between countries in terms of how resi markets work. Tenant protection, regulatory systems, ownership patterns, the physical nature of the buildings themselves, all these are very different between countries. So it's useful to dig back into history. A lot of these differences can be tied back to how each country dealt with housing shortages after the destruction of World War II. In British cities, neighborhoods leveled in the Blitz were redeveloped by local governments. Households that were once private renters became tenants of the state. In the 1980s, Thatcherism called for a shift towards private ownership. There was this massive right-to-buy program that transferred flats into owner occupation. The private rented sector, or PRS, was squeezed by tenant-friendly rules to less than 10% of the housing market. In the 1990s, these rules were made more landlord-friendly, so that by 2015, PRS stock had doubled. But until recently, landlords were private individuals owning individual units, not institutions. Given the lack of whole building residential assets at scale, many institutions have chosen to access the sector by building their own in partnership with a developer. This has led to the emergence of the build-to-rent or BTR market. BTR product resembles multifamily product in the US. Landlords compete to attract young professionals with on-site leasing and management, and amenities and services such as handling package deliveries. Investors can drive performance by offering the right combination of these amenities for their target market. The German market, on the other hand, looks very different from the US, owing to its very different history. As in the UK, post-war replacement housing was built quickly, in Germany's case by a mix of local governments and state-linked industrial companies. But unlike in Britain, Germany's political winds did not shift in favor of homeownership, and the country remains a nation of renters. It has one of the lowest homeownership rates among developed countries. Instead of being sold to individual occupants, German rental housing was traded in large blocks to private equity investors in the late 90s and 2000s. These portfolios form the basis of the listed companies that now comprise the largest segment of the European listed real estate universe. Germany's post-war rent regulation system remains in place. Tenants tend to stay for the long haul, on average 8 years. Vacancies are very low and amenities are relatively rare. This has contributed to a low-growth, low-volatility investment proposition, with attractive but slow-going opportunities for enhanced returns through gradual renovation. You can spot these differences between the UK and German markets and how those have impacted risk and return in the real estate performance data. While residential in general looks good in terms of risk-adjusted return compared to other sectors, German residential has been lower returning and lower volatility compared to the higher volatility but also higher returning UK residential market. We expect this diversity of investment profiles to continue to drive investors to increase allocations to European residential.